Hello, fellow Rebel Capitals. Hope you're well. I am back with my good buddies at Glenorchy Capital. Gentlemen, why don't you go ahead and introduce yourself for the people that don't know who you are? Just give a short Reader's Digest background on your experience and what you've done in the business. And then let's go into this slide deck and talk about not just the insanity of the Mag 7, NVIDIA, maybe how NVIDIA could possibly even be a scam, and then we can go into some of the things that people can do that might have better risk reward. So Chris, let's go ahead and start with you, buddy.
Sure. So we've got my good buddy and longtime business partner, Brad, on the call with us as well. So we run Glenorchy Capital, which is a managed fund whereby we invest into deep value long-term assets. We've been running that for quite some time. And as probably those of you who've been listening to this channel for some time, you've been familiar with who I am probably anyways. But Georgia has partnered with us in that fund as well. And so our background is quite varied. I've run a venture capital firm in the past and then got into this side of things together with Brad back in, 2016, I think it was originally. And
But you were
Brad,
kind of
you
a
can
Wall
give it
Street
quick.
guy before, weren't you?
Yeah, but that was
Not the stereotypical Wall Street guy, but you had a job.
I had a job, and I realized I didn't want a job, and I'm not a job person. But no, look, the background has all been in finance. Despite having gone down different paths, it's always been related to finance, So where I built a real estate company, it was just determining markets and looking for risk reward profiles that were favorable. Same thing with venture capital. And then that's also what led us into the it's what led us into Glenorchy, which is much more varied, and it gives us a whole lot more flexibility and liquidity. And there's a number of attributes as to why I think that's very, very well suited for me. But nevertheless, a key component, absolutely 100%, is Brad in that. And so we've been working together.
Well, I'm actually shocking myself because I'm thinking, I've been trading global equities for the last 15, 20 years, and I actually thought about it. It's like, hang on, no, it's actually 30 years.
And then, I do that all the time.
And then I started doing some more numbers, and I first started investing in 1986. So I went through everything in between. So the 87 crash, the Gulf War, the Asian tiger crisis, long-term capital crisis, the tech bubble. Been there, seen it, and got 5 T-shirts in my wardrobe. It's a pretty big wardrobe now. Yeah, so we've been investing in global equities now for 30-odd plus years. And what we do is we look for value throughout the world. Wherever value sits in the world, that's where we're interested. And generally, it's taking us to places where to markets and sectors that people would dare not touch.
Yeah, and that's the edge. That's
the edge.
That's one of the edges I think you guys have. So on that, let's go into the chart deck, Brad. I'm going to go ahead and do a screen share because a lot of the people or a lot of the viewers know that I was in St. Bart's talking to other really, really smart guys last week. And I think a lot of what you're talking about kind of dovetails on a lot of the topics that we were discussing at a very high level. So I'm really interested to get into this to get some actionable takeaways for the audience. So go ahead and all right, Japan crash.
So very quickly, I'll just give my 2 cents and then we can rock into it. So folks, you've always got, there's that saying that history doesn't repeat, but it rhymes. Essentially, you have these trends in motion that take place over time, and we can often go back and we can look at what factors were involved in certain market peaks, bubbles, crashes, you name it, even periods of nothingness, if you will. And how that consolidates industries, which is actually often how we land up finding the kind of equities that we like buying, which is where you have these long consolidation periods. Nevertheless, if we're looking at Japan, right, so the Japanese stock market bubble, which most people will have, if they don't know very much about it, they will have heard about it. This was a time when the grounds of the Imperial Palace were valued at more than the entire California, and all these. There was a whole lot of different metrics, which when we look back on them now, people go, that's insane. How did that even possibly take place, right? And yet here we are today. And we're going to show to you today how the structure of the market back in 1989, which was the peak in the Japanese Nikkei,
Mhm.
how that looked then on a relative basis to the world. And then we're going to show you what the US market today looks like, again, on a relative basis. And we're going to walk you through a number of the charts and dynamics of that. So,
Yeah. You know what's
go for
funny,
it, Brad.
Chris, is there was a gentleman who did a presentation last week, and he started his career in the late 80s in Japan. And so he was telling us what it was like actually on a daily basis. And he just said that every single day the stock market would go up. And it just got to a point where everyone knew that that's just what happens. It's a given that every single day the stock market is going to go up. And you just get to a point, and it lasts for any rational person. They knew that that's impossible. Like it's impossible for this to happen indefinitely. But they got just wrecked in the process because this was like most bubbles. It's something where the market can remain irrational longer than you can remain solvent. But he said that was the feeling, and that was the feeling of the retail investor, that just the market goes up every single day because that's what it does until you get to a point where it doesn't.
What's interesting, George, is that as human beings, we can look at things and say that's not necessarily rational. But if we're seeing it, then your mind still says, but it's happening. Okay. So you could say, well, the market valuation, it's too expensive. And the next day it goes up, as was the case in the 1980s all the way through till the peak in the Nikkei. And what we do is, as human beings, we have to rationalize what we can see. We can see that the market goes up. And so there's a portion of that market who would then justify it, and they find reasons as to why this might be. And it's actually not an irrational thinking process, right?
Right.
Because you could say, well, a PE shouldn't be 40, or 50 or 80. But you go, but it is. I can see it is. And so is there something that I'm missing? Is there something new? And that's where you get all these narratives that come in that say, this time it's different. This time we have something that is totally unique,
Yeah.
And we saw the same thing with, the internet bubble, Global Crossing, Pets.com, all that sort of stuff, right? There became a rationalization that people had to justify what was taking place, because otherwise you feel like you're insane, because you go, this can't be. And you wake up the next day and it is. And you
Right.
go, it can't be. And then it is. And so your brain has to go, well, there must be a reason why it is. And maybe I'm missing that reason. And then, of course, you'll have a number of people who will accentuate that. And so
And I
it's
think the rationalization process there, especially for retail, Chris, is they get into this mode where instead of value equaling the price or price action equals the value. So if the price is going up, then there has to be value there. There has to be value there, or the price wouldn't be going up, as opposed to just disconnecting the two and saying, let's just start with the value and forget about the price for a moment.
There's a massive disconnect to value. I mean,
Yeah.
so I just had my sister come and stay with us, and bless her, she's lovely, but she doesn't understand a lot about stock markets anyway. So she lives in Dubai, and she bought a couple of stocks through her banking app, and she said, "Oh, this one, and they've done really well, right? Because Dubai has been a conduit of capital from fleeing Westerners. Nevertheless, she buys these things, and they've gone up. And she says, "What do you think?" She said, "This one's gone up a lot, and it's done really well. And it's gone up 3 times in like 18 months." And she's like, "Should I buy more?" And I was like, "Well, let me have a look," right? So I started looking at PE ratios and things like that. And she has no idea what I'm talking about. She goes, "No, but the price has gone up."
Yeah, right.
So she's focused solely on price. And that's how the vast majority of retail investors determine something. They either determine it based on the price action, as you correctly referenced, or they look at the price as in a number. In other words, a stock that's a $2 stock to them is cheap compared to one that's a $4 stock. Okay. And it's got nothing. We don't know about free float. We don't know about impact. So, but again, you almost need that environment in order for these crazy bubbles to transpire.
Yeah.
Right? You need to have the disconnect between value and price such that these things can take, because if everybody understood value, we wouldn't get that price action.
Mm. Yeah, and then that goes into the percentage of the capital in the market today that's passive and active. But
Correct.
that's a completely separate topic, or maybe it's not. But let's keep going here,
Yeah.
and then maybe that'll be interesting to kind of sprinkle in that topic.
Yes,
But
I
again,
can,
we can look at sort of at metrics and how far they get extended, and this is where it's
yeah,
important because sorry, Brad, I'll let you go, but
yeah.
we've got some historical data points that we can look at to see what it looked like. So head off with Japan, Brad.
Yeah, well, this Japanese thing, I remember this. 1989 was my second year at university, and we were fed all the stuff about the miracle of the Japanese economic miracle.
Yeah.
Yeah, looking back on experience now, and it's goodness gracious, if I go back that far, how many years is that? That's like 40 years, isn't it? Thereabouts. Oh my goodness.
Yeah.
Oh, there we go. So, when you have this excess behavior, excess optimism, euphoria, this time is different. It always ends in tears. That's I can look back now in 40 odd years and say that. And if I was a bit older, or much older, I could go back and talk about the Nifty 50 craze in the 1970s. But of course, if I was talking about that, I'd be near dead. Anyway, beside the point. The point is that excess behavior always ends in tears. The problem is it ends for reasons it's very, very hard to comprehend at a time.
Yeah.
All right, so just sort of going back here and sort of jogging folks' memories, if you did have the memory or if you didn't. This is an article from the Aussie Financial Review. The date is 1989. In essence here, the market value, it says here, the market value of America's six most profitable banks, or six biggest banks, whatever, is about $42 billion, which is just 8.5% of the six biggest Japanese institutions.
Wow.
So you could say just round things up, all right? So you could say back then the US banking sector was about 10% of the Japanese banking sector, and crazy things like that went on and on and on. This is even though the Japanese GDP was actually still smaller, half of the US at the time. Crazy.
We'll go back to that first slide, Brad. I think we've got it there, which is market cap and then GDP. So we had market cap weighted. Japan was 40 to 45% of the world index, and it was 15% of the world economy by GDP. Okay, so size of economy 15%, size of stock market 45%. That obviously now today is reverted all the way back to 67% of the world MSCI World Index. Today in the US, we've got a similar dynamic. In fact, it's worse insofar as today GDP by purchasing power parity is, call it 15%, right? Similar, very, very similar to Japan. And yet we're not 40 to 45% of global market cap. We're 64%.
Yeah. So let me just, for the people who are listening on the podcast, Chris, let me just go over this really quick because they're not going to be able to see what you're talking about. So in 1989, the Japanese stock market was basically 45% of the global economy, but their share of the global economy, as far as their Japan's domestic economy, was 6 to 7%. So their economy, 6 to 7% of global economy or global GDP.
15% in 89. Today it's 6 to 7.
I'm sorry.
Yeah, and so 1989 was 15%.
Okay, got it.
Which is similar today to the US in terms of GDP.
Okay, yeah, that's okay. Got it now. So the stock market was about 45% of the world index, but their economy, Japan's, was 15% of the world economy. Thanks, Chris. And today, as far as using that as a reference point, today the US stock market is 64%, but our economy is the same, basically 15%. So you could argue that by that metric, the US stock market bubble is way, way, way more extreme than the Japanese stock market bubble of 1989.
And then we can also further get down into the concentration within the US right? Because there's 493 stocks in the S&P 500, which have basically gone nowhere
Yeah,
for like 20 years, right?
yeah. So it's the S&P 7.
Yeah.
Yeah.
So what we got now? So what was, so US banking sector was about 10% of the Japanese. Well, now look at it. I mean, I guess we could have gone back, a few more years. It'd be more extreme. So the US banking sector now is 33% of the world banking sector, and Japan is now about 8. All right. Now, this is where things get it's scary, but it's also comforting. So the Japanese stock market peaked in 1989. So what we got here, we've got an index of the Nikkei and the S&P 500, all in US dollar terms. I've indexed it back to 100 as of 1989. Now, so as of 2000, it was down 30-odd%. In fact, in 1998, the Nikkei was down about 70% from its high in 1989. 10 years prior, more or less, down 7%. The S&P...
And that's not inflation adjusted.
No, just, that's just raw.
Just to make the point.
Yes. Now the S&P, and this is on a total return basis. So you take dividends and reinvest them. And so the S&P was up, if you see 500 there, was up 400%. So Japanese stock market in the 10 years after the crash or the peak in 1989 was down 7%. The US stock market was up about 400. So the point being here, it's just one example, but yes, be very, very fearful of these markets that are extremes. But if you invest wisely, you don't have to be, it's like, oh, well, I'm scared. I'm very, very scared of the world stock market in 1989, 1990. Look at the Japanese stock market. This is crazy. I'm out. Well, look what happened. You would have lost exceptional amount of money by not being invested in the US stock market. Now you could argue, well, how who to know was it? How were we to know the US stock market was going to do so well? Well, okay, but it was very, very cheap at that stage. So comfort, like you invest in value, you can ride out these periods where the world's most popular market gets absolutely crushed. The same thing happened in the tech bubble too. Now, if you invested in I think the NASDAQ was down some 80-odd% from its peak in March 2000 to March 2003. S&P was down 45%. If you invested in a bunch of value stocks, and these things weren't hard to find, just big cap value, I think it was flat. If you invested in a bunch of small cap value stocks, I think you'd up about 30% at the time. Whereas the S&P was down to 45%. So, we've been through this before. Where there's value, don't hesitate, be invested. And if you just stay away from most, world's popular markets, highly valued markets, you're generally okay. So,
Brad, how do you determine if something is cheap for the right reason versus value? Because if it's cheap because it should be cheap, then it likely gets cheaper. So you get like a value trap, I think they call that.
Yes.
Well, you guys avoid the value trap.
Just look at cash flows.
Okay.
It's at the moment outside the US, it's very, very easy to buy stocks that have been producing, great returns in terms of cash flow, for PEs less than 15, less than 12, about a third of the US stock market. So look for cash. That's the biggest. It's very, very hard to hide by looking at cash flows. Profits, you can do all sorts of things with net profit, but you can't hide cash flow.
Okay.
What we got here? Now, this is the greatest risk that very, very few people are taking into account or aware of. NVIDIA now 8% of the US stock market. Technology, depends how you define technology, I guess, but technology, some 46% of the US stock market. It's clinical insanity. And it gets even more pronounced if we go further forward and look at the world stock market. Now, this is, you think, oh, well, I'm not invested in the S&P 500. I'm invested in a pension fund. I've got my pension funds with an insurance company, whatever.
Yeah.
Tell you what, all they're doing is quasi-indexing to the S&P 500.
Yeah.
It's kind of scary, George. If you've got a 5% weighting in NVIDIA in one stock, that's actually underweight. Underweight the index. I've never seen this before.
Another way to say that, Brad, is most people's retirement is almost entirely dependent on NVIDIA.
Yes.
The scary part, George, is that the vast majority of funds, people's 401k plans, that they think that they put them aside and they kind of don't look at them. They'll probably have a portion of capital that's active, right? They might have a brokerage account, they trade it, and they actually pay attention to it. And that, shall we say, passive capital is, or at least passive from the retail individual's perspective, and certainly passive from the institutional firms that hold that capital, right? And I say that because they're not active fund managers. They're just asset allocating across algorithms. And that capital is invested into this very these things. And which is, of course, how you manage to get to the point where you have market cap weighting of like 64% for US equities. Like, you go, how do you get there? Well, you get there because you have all these institutional capital that's just pouring into it, because Joe Sixpack in Iowa just puts his money into his pension, and it just lands up getting channeled through, and boom, there it is.
Yeah. So
Which
if
is why we
$1
wanted-
goes into the S&P index fund, a larger and larger and larger percentage of that $1 goes to NVIDIA, because
Exactly.
they're the largest stock, their largest market cap.
And where there is some risk mitigation on a risk parity trade, they're going to be holding bonds. And they're holding bonds at a time when we believe in our book that we peaked in the bond market. And if you just want to look at interest rates over time and historically, owning bonds now is for us, it's a difficult choice to make. It's not one that I'd make. So you've got, on the one hand, you're basically long NVIDIA, and on the other hand, you're long bonds, which is, you don't need to be there. And we think that is an incredible risk. But carry on, Brad.
Yeah, I think if I go to the next slide, okay, this is the same as the previous slide, but just taking one block of that. So we're looking at the weightings of individual stocks in the index, and also the weighting of individual sectors. Now look at energy, 3%, same as Meta. We look at industrials at 8%. So you take Honeywell, Caterpillar, GE, all the big industrial conglomerates, put them all together, and that comes to NVIDIA's market cap. Now look, a bloody 5-year-old can tell you that there's something wrong here. You would think. It doesn't take a rocket science to work out something is not right, and this can't go on much longer, I wouldn't think. Well, I did say it 12 months ago as well. Okay.
Yeah, but
Now,
so how do you manage that, Brad? Because the market can remain irrational longer than we can remain solvent, which is basically saying that you could have had this argument. You could have had this argument for the last 5 years at least, maybe the last 10 years. So how do you manage that?
Well, we look for value where no one else looks at it. Now, one of the markets we've been invested in for the last few years, 3 years plus, has been the Greek stock market. We won't talk about Greece here, but it's just one example. Another untouchable 40-foot barge pole. I mean, investing in Greek equities going back 3 years ago, 4 years ago, is like, are you clinically mad? Yeah. And that market has outperformed the Magnificent Seven in that time.
Yeah, right.
The same with the Argentinian stock market. That's actually performed better, so on and so
Dollar
forth.
terms?
In dollar terms, yes.
Yeah.
Yes. We're investing in a bunch of ADRs in the US. So while NVIDIA's caught all the attention, and likewise with its Magnificent Seven mates, there's other markets out there that are exceptionally well. Now, there's other markets out there we'll be invested in. It's done okay, but not to the same extent. So getting back to your question, George, we look for value outside what's popular, and usually what happens is that across all the themes we've got a few themes that are doing exceptionally well, which keeps us up there.
What was the catalyst and or tailwind for the Greek market that made you guys pull the trigger? Like, as an example, the catalyst with Argentina, you could argue, was Malay. And the fact that Malay is in there for 4 years, or hopefully 8 years, that's a significant tailwind that you guys have. And you always want to invest with some sort of tailwind at your back. So what was the catalyst and the tailwind for the Greek market?
We still don't know, George. The Greek stock market, when we invested, we were picking up companies on Ps of 5, reasonable dividend yields.
Basically, it comes back to cash flows.
Yeah, they were cheap.
You just
And
get,
the,
you get
George, the
strong
same
cash
thing
flows.
happened. Yeah, the same thing happened, George, when we invested in Argentina. And this was back in 2021, I think it was.
Hmm.
We're picking up banks in Argentina on P's of 5, dividend yields of 6, something like that. It was crazy. It wasn't just banks; it was across the board. Cement stocks, pipeline stocks, you name it. It's like, hang on, what's going on here? This is just slap you in the face value. Now we never knew of Millet back then. Then Millet came along, and okay, you could say, well, we got lucky, fine. And those markets are up, 3, 4, 5 times since we bought them. The catalyst, yeah, it's like you could say, well, actually things were moving up before Millet got in. Maybe obviously he's pushed things along. The Greek stock market, we still don't know what the catalyst is, but those stocks were very, very cheap, and they're still very, very cheap, even though they've gone up, about 3x. So the catalyst will come along, just as by the same token, the catalyst will come along for reasons you never thought of that pushes these markets down.
Hmm.
I think it's one of those things where, like, I can't recall who said it, although I've heard a number of investors say a similar thing, which is that if you wait until you have all the information, you're too late, right? You can't wait till 100% of the information is available, because then everybody has access to 100% of the information. And so you've got to make these judgment calls. And for us, like, we're at the coalface, we've got to make the judgment call, which is also why we asset allocate and we have position sizing, which is extremely important, and people don't pay enough attention to it. But
Yeah.
where you have very strong cash flows and you have, like, say 80% of everything that you would need to know that's in place, now it's just a matter of how much do you position size. Is it a 5% weighting in your portfolio? Is it a 2% weighting? Is it a 10% weighting? That's more the judgment call, right? And so you can change that too. So, like, with respect to Argentina, we first started investing in that partly as a consequence of the cash flows. There was another little dynamic which I kind of had a theory about. I wasn't sure, but it was that we had, if you recall, a whole lot of problems in Brazil. Bolsonaro was getting kicked out, and, like, there was political dysfunction, and I knew that asset allocators into South America basically have 3 options, right? It's Brazil, which is the largest, and then it's Chile, and it's Argentina, which is tiny comparatively. But Brazil was going through a problem, and Chile had already swung pretty hard left. So capital had already sort of fled Chile to
Right.
some degree, and then it was sitting in Brazil. Now Brazil was a problem, and I'm like, where's it going to go? It's like
Right.
it just took a trickle of it to go into Argentina, not necessarily because Argentina was better, but it was potentially, on a risk-adjusted basis, less worse than Brazil.
Hmm.
Okay, it wasn't that the risks were less, but it was that the pricing of that risk was significantly lower comparative to Brazil. And at the same time, we saw these very strong cash flows and everything else. We're like, that's fine. So we took a 5% weighting, and you can easily have, like, if we'd gone in and lost 50%, say, it's not a big deal. It's 5% weighting, 50% on 5%. Like, we can manage that risk. And then, of course, as things transpired, we bumped up our positioning, and then, of course, we've had massive outperformance. So now you're sort of getting into the bucket where you're like, oh, do we want that bigger weighting in Argentina as a, but back to your point of what's the catalyst,
Yeah.
like, there is a number of things at any point in time which you could look at and say that potentially could be, but the fundamentals behind it should always be strong cash flows, like deep value, right?
Yeah.
Because that provides some level of risk mitigation. Because if that catalyst doesn't come along, or something really messed up comes along and does the opposite, you want to have that underlying base. And to that point, if you look back now and you look at the US stock market, Microsoft, Nvidia, and all of these, tell me where's the base?
Well,
I can't see
I'll tell you where the base is. I don't
It's
know what the
lower.
base is. Well, I like to get these little sound bites. So
What do you? I know you guys have done a lot of analysis, or maybe you haven't, on Nvidia, and just out of disbelief, I'm sure, and just pure morbid curiosity. What do you think about that bearish argument that there's like circular revenue? Because I talked to Mike Green, among a couple other guys, and they were outlining kind of how that works, and they have a lot of skepticism as to their true earnings
So
might be
it's a good
not
point.
necessarily, not only is it wildly overvalued, but the true earnings might not be as they seem.
Look, our viewpoint is that we don't need to make that judgment call. Why? Because we're not invested into it. We understand that this thing is going to revert to the mean at some point. What
Yeah.
does it? I don't know. But what we also know is that when you have capital that gets allocated, I would say misallocated, at such an extreme, egregious level, always you have shenanigans going on, like every single
Accounting
time.
shenanigans. Yeah.
And so is that true of NVIDIA? I don't know. But again, we don't need to know. For Brad and I, we prefer to spend our time on saying, okay, we know we don't want to be there, and we know that there's a risk there. So where can we find value? Where do we actually dig and look to allocate our capital? Because it's time better spent. So it's a good intellectual sort of conversation, and at some point we will probably find out. But there's always shenanigans that take place at the peaks. Or during significant misallocation of capital. Just one other thing, if you go back to what was that first chart? We had the Nikkei versus the Nasdaq back from '89. The trade to make then, George, was quite easy. You could see that on a sort of GDP basis, the US was undervalued, was significantly undervalued, and Japan was massively overvalued.
Right.
That's all you needed to know. If you had simply traded your Nikkei shares for the S&P or the Nasdaq, you killed it for the next 40 years, right? That was the trade, was to go, not necessarily to short it, because who the heck knows how high it could go, or there's problems with shorting. And one of the significant problems with shorting is probably the cost of your mental therapist. But it's not a game for us. But nowhere not to be. I would say today, and we're of the opinion that a similar trade exists insofar as getting out of the US. And I know I'm going to get hate mail for this, but going into China, if you look at Chinese equities, China's share of global GDP, all that, the same dynamics, it's a very similar position. So there's another chart.
You have a chart on that, Chris?
Yeah, well, here we go. So this is the All Country World Index, the ETF ACWI. Now, the weightings are based not on market cap, but the free float. So take the freely trading shares and your basic market cap on that, or at least a weighting on that. So the point being here, George, look, so for NVIDIA to double in size, okay, it's got to find twice the free float, or essentially twice the market cap or the free float weighted capitalization of the Chinese stock market to do so. And it's like, huh? Yeah. It's clinically insane. And if you look at it on a market cap basis, it's not here. But for NVIDIA to double in size, it's got to go up to the same market cap as the Chinese and Indian stock market. And you start thinking, okay, what's the upside here? Limited at best. Downside, pick a figure. and so on and so forth. So now technology, now 37%. Can you believe it? Round up to 40%. Maybe it's there next month. 40% of the world stock market. 40% in one sector. Like energy, 3%, 4%. 3.8%, 3.5%. I think it is the weightings in energy.
Yeah, I think that's really the key. It's not about whether or not it'll go up. NVIDIA definitely could go up. I mean, it's been in this insane zone for, let's just say, 2 years. So the question isn't whether it can go up or even whether it will go up, but what's your risk reward? Like how much could it go up versus how much could it go down? I think that's really should be the starting point for most retail investors.
That's it. Yep. It's scary. And you look at the Chinese stock market, they're 2.5%, the same size as Switzerland on a free float basis in terms of market cap. It's like, huh? Now, just a 5-year-old can say, hey, there's probably a lot of value in Switzerland. Sorry,
China. What's the risk that Trump just pulls a Biden with Russia? Right, that if you own Chinese shares, just you're unpatriotic and MAGA hates you, so you don't deserve your money anymore.
I mean, China's already won this war, and I say that because you can't sanction the country that makes that supplies your weapons, and that's essentially what is taking place. Like all of the sort of high tech componentry gets assembled in in the US and war even in Canada. But all of the underlying components and the entire supply chains are controlled by China. So you can't sanction that country. I mean, you can, but like it's probably a fairly catastrophically stupid idea to do so. And sanctioning China is not the same as sanctioning Russia. So anything's possible at this point in time, but I think it's less probable. That being said, part of the reason that the Chinese market cap is the way it is for that is because of that risk. That risk is priced, right? So if we go back to when we started buying into Chinese equities, when was that? A year and a half, 2 ago, probably
Just
2
about
years
2
ago.
years. Yeah.
2 years ago. This was just after that, so that Russia had been sanctioned. Wall Street got very worried that there would be a similar dynamic in that the US would sanction China. And certainly there's a lot of rhetoric to that degree. Reuters were publishing it, Bloomberg, yada, yada, yada. A bunch of the clowns in Washington, D.C. were talking about should they, debating it, if you will, whether it was just propaganda or not, we don't know. But this is when Chinese equities sold off pretty hard. And so there was 2 interesting things that took place there. First, you had large cap, especially internet stocks, Alibaba's, JD, et cetera, all sold off very hard. That's why we went later on after they'd bottomed out and we started buying them. And we think there's deep value there. Now, again, it's a position sizing issue. So if they do get sanctioned and we lose a 5% weighting, do we get run over? No, we don't. But is that risk already priced? We think so, because the market's already liquidated it. And that liquidation was interesting because it was basically all of your it was your Vanguards, it was all the mutual funds that own these Chinese equities that sold them, right? So you can only sell what you own. That's where the risk lies. A lot of the stuff that we buy, and we had this experience because we had a lot of weighting into some Chinese or Hong Kong equities, they went nowhere. They didn't go down. Why did they not go down? Because they're often smaller cap, medium cap companies, $1 billion market cap here, $1 billion market cap there, which is to say that the Vanguards, the State Streets, the Fidelities can't own them. If you're running a $4 or $5 billion fund, you can't buy those companies at all, not even for a 1% position size. So they don't. And so us owning them, in fact, they went up. So while you had headlines about China's market crashing and all of this sort of stuff, and certainly that's what it looked like when you pulled up the chart of the big cap stocks. Our stocks, a lot of the stuff that we owned were going up. So this is where it comes back to risk mitigation, right? If we see this concentration of capital in the US markets and then in NVIDIA and then in the Mag 7, these are all large caps. So large caps, I mean, if you had to stay in the US, I'd get out of large caps, right? Because that's where the concentration of capital is.
Chris, this may be a stupid question, but how does it work with the sanctions if it's only for U.S. citizens? So let's just go back to Russia, and assuming that you own shares in Sberbank or the ADR, and if you're a U.S. citizen, now all of a sudden it's illegal to own that. So your shares go into some sort of custodian and you get zeroed out. But if you were a citizen of Turkey, I assume that you still can own those shares legally because Turkey didn't sanction Russia. So is it on a country-to-country basis?
It's on a custodian basis. So it depends on who the custodian.
Okay, so your broker. So I guess the question there would be, when you guys invest the majority of the money for the fund, where is your brokerage set up? And does that location have a lower risk for these potential sanctions against China, assuming that the brokerage isn't domiciled in the United States?
It's a good question. So you could presumably set up a fund with multiple different custodians and brokerages and everything else, and run it like that. Very difficult to do, and certainly operationally, in terms of managing and reporting, becomes pretty onerous. So we have not done that.
Okay.
We try to manage that risk on a weighting basis.
Got it.
Right, as in, how do you weight that position? So I think the risk to China being sanctioned is greater. It's priced. There's a greater pricing of that risk than I think the reality is, and which makes sense because Russia has already been hit with that. So now everyone's like, oh, like who's next? Everyone's going to be next. Like it's it's on the forefront of people's minds, and as a consequence, it gets priced, right? And so it's like if a tidal wave. I still remember the Boxing Day. You remember the Boxing Day tsunami in Phuket? I don't know if you remember that back in 2008. I think it was.
Yeah.
Or four, was it 2004?
Yeah.
Shit, I'm getting old.
Yeah.
Anyway, I remember after that, because I was traveling through Southeast Asia a lot. Like it didn't matter where you were, any beach resort, could have been Indonesia, Philippines, Malaysia, Thailand. Like everyone was like now so concerned with a tsunami.
Right when the probabilities of another tsunami were almost
zero. They were probably the same, right? Roughly as they were like at any other time. I don't know if they were any lower, but they certainly weren't necessarily higher. Okay. But the perception of it was like, and then assets got priced accordingly. So like stuff that was beachfront lost value, right? Because people are like, no, I want to be up in the hills.
Oh yeah.
Look what happened to those guys, right? So it's it's that recency bias, right? So we've got recency bias with respect to sanctioning of Russian equities, which is now, I think, providing an opportunity for us in a place like China, which is priced at a level that is disproportionate to the actual risk. Now, that doesn't mean that they don't do it. I'm saying it's just a disproportionate pricing of risk.
Yeah.
And so now it's a position sizing question. But you can buy this stuff. I mean, we've been buying like the small caps and that. It's very cheap, like very cheap.
Yeah. Okay. So we've talked about small cap China. I think you guys might have had some tech as well. We talked about the Greek stock market and the Argentinian stock market, banks specifically. Where do we go from here?
Well, it's also sectors as well, George. I mean, one of the other the sectors, energy. We tend to focus on those sectors which have the least weighting. Energy is a massive sector, but it has like a 4% weighting in the world stock market compared to.
Now we're about, so just for clarity, guys, that listening to the podcast, we're talking about the world.
That's right.
This is the world stock markets, not just the United States. When we say
world index,
when there's a 3.81 allocation to energy, that would be the aggregate total of the world equities, global equities.
Correct. Okay. That's right. 3.8% is allocated to the energy index and the energy sector in the world stock market, and tech is like about 38% weighting.
Okay.
Well, that's just the same thing again. All right. So this is a bit about China. Chris, you might want to run through this. This is remarkable.
Yeah, I mean, again, it's like we started off this particular podcast, right, detailing and highlighting how Japan got overvalued relative to the world, and you could see GDP is kind of a shitty measure, but it still is a relative measure that's useful. Mm-hmm. So we started off looking at that, and we looked at what Japan was like in 1989, and we looked at what the United States is like today. Now, if we contrast China versus the United States, these are some of the metrics. Okay, so you've got in terms of purchasing power parity, which I think is one of the most more accurate measures. China is a smidgen or quite a bit more than the United States. Okay. Based on that, you could argue then, therefore, that the equity market capitalization should be equivalent or certainly larger than the US. And we can see a huge disparity in that respect. Now, there are some reasons behind that, but certainly that's a disparity that's very, very hard to ignore, which is you've only got 10 trillion in market cap in China, and you've got over 50 trillion in the US, which accounts for about an 80% differential. Same thing, share of global market cap. China's sitting around at just over 11%, and the US, as we mentioned, 64%, call it 60. And then you've got the pricing, right? The PE ratios, trading PEs. So in the US, your average is sitting around 25, and it's less than half that in China. So when you look at it from that perspective, and again, you go all the way back and think about that chart that we showed you, where you had the Japanese stock market, and then you had the Nikkei, and you had the NASDAQ, the trade then to make was very simple. You just sold what was expensive and you bought what was cheap. And you could literally have just sat on that for the next 40 years. And remember, the people who bought in the peak of 1989, they will wait probably for about 70 odd years. If you go historically, when you have massive peaks like that, inflation adjusted, you wait about 70 years, which is to say you're dead. It's a significant impairment to your net wealth if you get it wrong.
Yeah, it's funny, guys. I did a video the other day talking about this idea of buy the dip, and that the stock market always goes up, and it's about time in the market, not timing the market. Just all these narratives that we always hear. And so I went back and looked at the S&P 500 from 1930 to 2020. So you got 9 decades right there. And if you look at it, 4 of those decades, if you adjust for inflation, the S&P 500 was down. And then 4 of the decades, the S&P 500 was up. And then 1 decade, it was flat. So what I'm saying there is it was a coin toss. It was a complete and total coin toss. So what people are doing is they're betting that they're just going to flip a coin and it's going to come up heads every single time for the next, 40 years or 70 years. And keep in mind, that's not even adjusting for the valuations at the beginning of XYZ decade, right? So I didn't do the math, or I didn't do the research, but I would assume that the decades where the S&P 500 went down, they started off that decade with a really high PE and they kind of mean reverted, and vice versa for the decades where it actually went up.
It's a cliche, but it's just keep it simple, folk. It's like buy what's cheap and sell what's expensive. And it's hard for people to do because they see something that's we know is expensive, but they're like, it's going up. And then there's all the narratives that explain why it's going up and why it will continue to go up. And people get caught up in the narratives instead of just saying, is it cheap? Is NVIDIA cheap today? Like it's very difficult to make the judgment that it is, right? And some people are. I mean, again, narratives build markets, but that's all you got to do. And if you go through those periods that you just referenced, my strong suspicion would be that if you just did that, if you said, is it cheap? And you sold it when it was not cheap and you just bought it when it was cheap, yeah, you're not going to get the tops and the bottoms, but just use that basic metric as your guide and forget about price. Just forget about price. What is the value? What's the valuations? Are there strong cash flows? Yes, no. Cool. Okay, allocate. Are there strong valuations? No, they're very, very high. Are there strong cash flows? No, they're kind of poor. And we're getting dilution and yada, yada, all the things that take place in the peaks. You go, okay, get out. But
I think, Chris, that's all very easy. But, when you come to, you've got to go out of markets that are very, very popular, which is, it feels an easy thing being in there. And then you've got to go into markets that no one wants to touch with a 40-foot barge pole, near enough, like China, or sectors like energy. And that's really, really hard. And then also what you've got to do is you've got to invest outside your country, your home country. And now, of course, most of the listeners here will be American. It's very, very difficult for folks to get in the mindset. It's like, oh, well, okay, I'm going to go buy some stocks in Greece or buy some stocks in China or Singapore. Now, the thing is, on many platforms, or we can think of one in particular, it's as easy buying stocks in Singapore or Hong Kong or Israel as it is buying stocks on the New York Stock Exchange. So you've got to start seeing, I think folks got to start seeing the world as their oyster instead of just like being focused on the US, particularly now. Well, I think we've just proved that it's extremely risky being invested in the US stock market. And it's outside energy in the US stock market, it's really, really difficult to find slap you in the face value.
Yeah.
Whereas
China, what's interesting is I did a video and kind of a thought experiment the other day where I was, if you really boil it down to the basics, there's only 3 levers that you can pull in a portfolio. That's it. Like you've got your win rate, you've got your asymmetry, and you have how many bets you can make per year. And that's it. You can't do anything other than just those 3 adjustments. And so most people are never going to be able to make enough bets or investments trades in order to have the law of large numbers on their side, because they're doing 10 or 15 a year. So if you had, let's just say, a 51% win rate with no asymmetry, but you made 1,000 bets a year, there's like a 99% chance you still win. Where if you only make 10 bets a year, it's it's obviously a coin toss. So most retail, they're never going to get there. So when I hear you guys, and the more I get to know you and know your investment strategy, it seems like the lever you guys are really, really good at pulling or adjusting is the asymmetry lever. Because, you know, what's your win rate? Maybe 65%, something like that.
Yeah, 60% probably. Well,
which, by the way, is good. Which is very good.
Depends what time frame you give us, George. You know, we can be.
Well, if you just look back over since you guys have been employing this strategy, say you got a 60% win rate, which, by the way, is great. Druckenmiller's 55%. But where you're really, really good is the asymmetry. So if you win, you're let's just say you make $2, $3, and if you lose, you only lose a quarter. And if you're doing that, I mean, you could have a 40% hit rate, and you're still going to make money, but you got a 60% win rate on that, plus the asymmetry, and that's a recipe for success. So if I look at it from strictly a mathematical standpoint, I think that's why you guys have done so well. That asymmetry.
Yes. I mean, we could use Argentina as an example. We were down 35% at one stage there in that trade. It's like, oh, that was a genius idea, wasn't it? And then, you know, a few years after that, it's like, well, they're up what they're up, you know, 3, 4, 5 times. Some of the trades up more than that.
Yeah.
So
you're doing that fundamental analysis and basing your starting point is cash flow, like you said.
Yes.
So if your starting point is cash flow and valuation, then by definition, it's an asymmetric bet. You're limiting your downside based on that cash flow. And then, you know, and that's a big if, but if the market comes to the realization of the same view that you guys do and allocates capital there, then you've got just this massive, massive upside. And that's how you guys play the game.
That's right.
You don't buy something on that speculation that market's going to come. That's just nice to have. That's the cherry on the cake.
Yeah.
And that's the risk mitigation, because asymmetry is not about upside. It's about two things. It's about limited downside and upside. And most people pay too much attention to the upside. They're like, oh, what's going to make this, you know, how am I going to get get unbelievably rich? I want a Lambo. Like, how do I get there? And they're not looking at the downside. And, you know, again, that's probably human nature. They don't look at the downside until they start losing money. And then they're really worried about the downside.
Yeah. Most retail investors have opposite asymmetry built into their strategy.
They do.
They not only have a win rate that's probably less than 50-50, they only make 10 bets a year, but then they have opposite asymmetry. So mathematically, the longer they do it, the higher the probability is that they either lose money or just completely go bust.
Well, it's like Rick Rule likes to say. He said the most dangerous thing in investing is what's between your two ears.
Yeah. Exactly.
And I like
the other thing, George, is it's time. You know, often the positions we put on, it takes time to bottom out. We can be wrong a bit for a few years, 4 years or more. The uranium trade, I recall we put that trade on in 2016, September 2016, and come September 2020, you had nothing to show for it. And of course, after that, it took off. In fact, at one stage when the uranium trade were down by 50%, it's not uncommon to be down 25, 30% in the trade.
But you can do that because it's asymmetric. If it wasn't as asymmetric, you couldn't get away with waiting.
Yeah, correct. I mean, look, the other thing too is, like, you know, that most of the time it's a 5%, between 5 and 10% position size. And you know, the essence here, George, if you buy things that are unloved, unwanted, they offer good value. You know, and you don't have to be a rocket scientist to work out what the value is, and you give it time, it's really hard to go wrong. You're going to get lucky. You know, so that's what we do. Give it, you know, we look for value across the world. Things are unloved, unwanted. We call toxic waste. That's the stuff we love to invest in. We give it time, and that's a recipe for success. And it seems easy. Being patient and sitting and waiting. What did Tom Petty say? The waiting is the hardest part.
Yeah.
That's famous lyrics.
So here's this Shanghai and the S&P 500. I mean, this goes back to what you're saying.
Yeah, Shanghai Composite versus the S&P. It's indexed to 100 as of 1996.
I'm looking at trying to see the chart. Looks like it's an all-time low.
Yes, it hasn't been any lower, well, since the 1990s anyway. So, and it's down, well, okay, it was probably too high back in 2007, 2008. But even if you go back to where it was in 2017, it's underperformed the US stock market by 50%. Yeah, there we are. So look, in essence here, if the S&P goes nowhere, for the next 5 years, just for argument's sake, the Chinese stock market can double, and obviously this index goes from being at 50 here to 100, and it's still cheap.
Yeah. The way I look at that, well, the first thing that comes to my mind is I look at where it was in 1996, and you think of what the Chinese economy was back in 1996 relative to where it is today, yet its stock market was more expensive relative to the S&P 500 back then, when China's economy was, I mean, not to sound harsh, but it was basically a giant rice paddy or something. It wasn't really technologically advanced. I mean, what, 90% of the population living in absolute abject poverty, and the stock market was more expensive relative to the S&P than it is now.
Well, look,
Correct.
I mean, I don't know what the China's share of global GDP was back then. Today, what are we, around 18, 19%? I suspect it would have been a fraction of that. Right. So again, there's just, you see these disparities, and that's what we like to do, is to look for these anomalies and these disparities. And then it's just a matter of, weighting that position.
Yeah. Correct.
And you do that across multiple sectors and multiple countries. And you build a portfolio where at any one given point in time, typically something's really outperforming for you, while, and this is the important part, while not taking significant risk. And that's where I see, so many, and we had this from a client, and they had their 401k plan, and they just hadn't thought about it really. And then they started sort of paying attention, watching YouTube videos and just learning. And they realized, holy smokes, we have all of this, like all of their net wealth, all of their pensions, everything just tied up in stuff that they had no idea about. So I think it's a significant risk, and it's just a risk that it's not noticed because it's passive. For most people, that capital is passive, and then for the institutions, it's passive, and they don't care. The thing is, they don't earn money based on performance; they earn it based on clipping the ticket on the fee. So it's a mutual fund that you pay maybe 85 basis points to, or 50 basis points, or whatever it is. And so it's just aggregation of capital. And so long as they can keep aggregating more capital into that fund and clipping the ticket on it, they get to live on multiple golf courses around the world and have private jets.
And how wild is it going to be when MicroStrategy joins the S&P 500?
Well,
and Grandma,
that's another thing. I don't know if you noticed,
Sailor's back pocket.
it's have you noticed how many of these Bitcoin treasury companies are now popping up?
Yeah.
And here's the interesting thing. A lot of these guys who originally in that were like, oh, that saying, not your keys, not your not your Bitcoin. And now they're running companies where it's like, it's not your keys. It's hilarious.
I don't even want to go down that rabbit hole, but I knew that if I mentioned MicroStrategy, I'd get a smile out of Brad.
Yeah.
Oh, great. All right, guys, what's the next chart?
That's I think that's it.
I think that's it.
Oh, that's it?
That's it.
Okay,
Yep.
cool. All right. Well, guys, if you're interested in finding out more about what Brad and Chris do, you can check out the appropriately named Rebel Fund. And this is the fund that I've got. These guys manage it, obviously. I'm just kind of the marketing component of it. But if you want to find out more about what they do, guys, can they just go to the website, or how do they do that?
Yeah, Rebel. Actually, I tell you
what is the URL?
I'll get the link for you, and then we can just drop it in.
Okay, yeah, guys, we'll just put the link in the description of this video in the pinned comment. check out the website and you're interested, you can book a call, and Chris can walk you through more of their strategies and see if it's something that might be right for you. So guys, thanks a lot for coming on. Thanks for all the insights. I did not have small cap Chinese stocks on the bingo card. I did not have the Greek stock market on the bingo card. But you know what's interesting? Just today, I looked at the position, it's a very small position, that I put on in, I think it was 2012, in LHH. You guys know what LHH is? The ticker?
No, I don't. What is it?
Lourdes Hotels on the Cyprus Stock Exchange.
Okay.
Remember when
that's
Cyprus did the bail-in thing?
That was when they got, their banks were screwing everyone.
That's right. Yep.
Yeah, and the stock market went down by 99% or something like that. So I heard Doug Casey talk about it, and I'm like, wow, that's value. That's some serious crisis investing. And I bought shares at like 11 cents or something like that.
Yeah.
And I just looked at it today, and they're up at like, I think $1.50 or something. And they pay a 3% dividend based on $1.50. So the dividend on my cost basis. So there you go. So is that deep value? Would that be considered deep value investing, guys?
You just got lucky, George. There we are.
Am I part of the team now? All right, guys. But thanks a lot for your time, and can't wait to do it again.
Thanks, George. Very good.
Thanks.